Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back. Hello, everyone. Welcome to 1929. This is episode 154. No, this isn't 1929. There's been some talk about this, Sonu. We're going to get into it. But first things first, it's fall. It's cooling off. I've had just terrible allergies. And as soon as Josh helped us here record, I realized I didn't bring my cough drops. I don't even know where they are. One of these questions, I might, like when I ask you about the Fed, I know you'll talk about 20 minutes. I might disappear for a while and go find my cough drops upstairs. But nonetheless, yeah, just Sonu, I know you got it. I'll see you in 20 minutes when we talk about the Fed. How are you feeling? This weather's messing me up. I don't know.
You know, maybe it's because I set a low bar for the season. I'm expecting the worst, and it's not yet been the worst. Okay. You know, usually I'm getting up in the morning and sneezing like 20 times. It's not been that bad. I mean, spring's always worse, but fall is, fall's a little more uncomfortable than. Strangely, winter is my best season because everything's dead. That's the reason I'm in Chicago, folks.
Well, there you go. Yeah, and I see. When do I get Chicago? 2 weeks. I think I'm there in 2 weeks. So
hopefully we got a thing up in Wisconsin.
Yeah, it'll be fun. I think we're having double dinner that day. Don't tell anybody, but I think we're having double dinner. So someone's got to do it.
We're always having double dinner when we meet up. It feels like double dinner.
Exactly. So, let's dive in. There's a ton to discuss. And by the way, last week was the recording live from Excel. With Dr. David Kelly, the Chief Investment Strategist over at JP Morgan Asset Management. Check that out. That was live on stage. And Dr. Kelly brought up so many cool things. A true titan in our industry. Thank you again to Dr. Kelly for joining us. But we're back live. And then next week, we're going to have another recorded episode. Maybe we'll mention later in this who we'll have next week. And then a live. So we're kind of bouncing back and forth between live and recorded. And for that reason, we have a ton to discuss. But Sonu, I do think I want to start with 1929 because let me read the headline. Okay. I've got it here. This is a Wall Street Journal article. The headline, Black Swan Manager Sees Huge Rally, which normally they don't say. But then the 1929 crash. Mark Spitznagel, hedge fund has earned bonanzas in market crashes. I mean, so many different thoughts about Spencer Jacob wrote, a big fan of Spencer. So many thoughts on this. We heard from our partners. We heard from people about this saying, wow, what if we're in a 1929? Now, again, he's saying it's early
in the Wall Street Journal, so
it's got to be true.
It's correct, right?
I mean, he's saying it's early 29, so we're going to have this huge rally and then a crash. So you're kind of covered either way. If we rally, I told you we'd rally. If we crash right now, well, my watch was a little off. I guess let's start with the fact that, a black swan manager is using hedges to prepare for a calamity. I mean, this is nothing new.
What do you think he's going to say, right? And the very notion, black swan, the very notion of a black swan is you don't expect it. Now, if you're expecting it, and if he's announcing to the world that a black swan's coming, think of what happens if everyone knows the hurricane is coming, the hurricane's on its way. Yeah. Well, insurance gets more expensive, right? In this case, the options that this guy buys, insurance basically, let's not get into putting options and things like that. The insurance this guy buys to protect against a crash will get more expensive. So if anything, I'm like, why is he telling the world? Right?
Interesting.
Why is he telling the world? Just go buy all the umbrellas and insurance you can buy before the rain and then sell it. So anyway, it's just, he's always being interviewed. Anytime there's a market crash, it's like, see how much we made. But nobody ever asks him, how much are you making? In fact, how much are you losing? When times are good.
Oh, you just reminded me of a good quote. The guy who trained Warren Buffett, Benjamin Graham, right? Benjamin Graham. Yeah. So I'm not a fundamental guy. That's why I grew up talking about John Murphy. Anyway, Benjamin Graham said, buy your straw hats in the winter. I always like that one. Yes. What else we want to say? We don't think it's 29. We're going to lay out many other reasons. Anything else you want to talk specifically about that? Or how do you want to take it from here?
I mean, what's ironic is, look, this guy used to run a hedge fund, I think with Nassim Taleb, the guy who did come up with the black swan, the terminology.
Literally wrote a book about it.
Yes, I have. Yes. I actually, it's a very good book. I have the book right behind me, The Black Swan, along with Professor Siegel's Stocks for the Long Run. So it kind of fits nicely next to each other. But look, they used to run a hedge fund for whatever reason. I have no idea why or how. They shut that down, assuming I'm going to assume it didn't do well because, obviously if you keep buying insurance, there's a cost to it. Now you may be prepared to pay that cost. I mean, all of us have home insurance and car insurance. Maybe a lot of us are forced to have that, but we do, right? That's a cost. Same thing, there's a cost to this. It's not cheap, right? And, so nobody ever asks them, like, what's the cost of this insurance? And anyway, they started this new fund a decade ago or something like that. And he's interviewed every now and then when, people are worried, is there a bubble? Let's go ask the crash guy. What do you think the crash guy is going to say? Anyway.
Yeah, I mean, I don't know. I got my son. My son's literally texting me, "Did you buy tickets to homecoming dance?" This is how you multitask during one of these.
Speaking, you know what my son asked me this morning is like, how much is, what's the cost of gold? Just out of the blue. We're walking to school. And I'm like, where do I go with this?
It's up again.
I'm like, I think I told him like $3,500 because it's like, round. Now today it's like $3,800 an ounce. Right?
It might be $4,000 by the time people listen to this. Honestly, it's gaining 2% a day. Yeah.
So he's like, "Can I buy gold?" And I'm like, "Dude, you come from, half your family is Indian, so which means you're going to have gold." I didn't tell him that because next thing he's going to make me go to the bank, that safe deposit box, and he's going to want to see the gold in there and things like that. But I'm like, I didn't even tell him that, right? Because I really don't want to schlep out to the bank and open a safety deposit box and find the keys and all that. But I told him, look, you can buy companies that mine for gold, right? And that actually segs into our guest for next week, right? We'll keep it, we'll let you guys know at the end of this episode who it is. But gold miners have been doing really well. And here I'm thinking, next year, I don't have an investment account for my kids. At some point, we've been thinking, okay, we'll open an investment account. They can put money into whatever, McDonald's or Disney or something. I'm like, maybe gold miners now, right? Yeah. I was like, I should ask Ryan about that.
Well, maybe I'll just say this.
Chicago, I'll let him talk to you.
We've obviously been quite bullish gold way before everybody else was. We started adding gold back in the first quarter of 2023. You saying that has contrarian signals running in my mind. When your son is telling you, "Let's buy gold, Dad," I'm like, oh, goodness. No, we'll talk more about that. Yeah. But
funny.
All right. Well, let's so 1929. We don't think it's 29. We're going to kind of lay some more groundwork there. Let's go to small caps. Small caps join the party is the way I like to put it.
Right?
Yeah. And Josh, I sent one chart about small caps, how historically they do after they make new highs. We can put that up on the YouTube channel here if I can get my pointer. Where's my pointer?
And it's nearly 4 years without a new high for small caps. So that's the chart.
So just big picture. One of the things we've been saying for a while is this is not a major bubble because small caps aren't at new highs. Transports aren't at new highs. Mid caps aren't at new highs. The Russell 2's at a new high. The S&P 600, which is companies that actually earn money and a little higher quality, that's still 7% away from all-time highs. So we expected new highs to happen across the board, and it is starting to because we're in a bull market, and we think other groups are going to catch up. But again, it was about 3.8 years, November of 2021. And again, on the YouTube channel, we're sharing. So when you go at least a year without an all-time high in the Russell 2 and then finally make one, what happens next? 1 month later, higher 10 excuse me, get all choked up talking about it. Higher 10 out of 11 times, and 3 months later, up almost 8% on average. So near-term momentum is real. And again, it's just important to remember for 4 years, small caps have literally gone nowhere. Okay, so that makes me think this isn't some big bubble. Maybe some certain parts of AI and technology, maybe, but hey, it's justified when you look at what's going on, in my opinion. But if you want something that's cheap, hadn't gone anywhere in a while, there are some groups that do that. So what's your take on the small caps finally hitting a new high here, Sonu?
About time. I mean,
there you go.
To your point, it's been a long while coming, and it's been a bit of a surprise, actually. I mean, 2 years ago? Even last year this time, maybe a year and a half ago.
Last September, small caps had a huge month. I forget the exact return, but September, they soared last September.
And we were like, look, the economy is doing well. We're getting 3% GDP growth, thereabouts, which is what we did in 2023, 2024. There was broadening out as well. Mm-hmm. Yes, I know the Mag 7 contributed a lot. That was more in 2023 than in 2024. 2024, the S&P gained about 25%. 15 percentage points came from the Mag 7.
Okay.
10 percentage points from everybody else. 10 is not nothing, right? You'd rather be up 25% than 15%. But we didn't see that participation from small caps. And that's one of the things we got wrong, right? We were overweight small caps at the time. Not a lot. It wasn't a big bet. Mm-hmm. Our big bet was still being overweight equities. And so we had a lot of large caps. We wanted to sort of balance that out. We had some small cap, a little more exposure than our benchmarks. And hey, that didn't work out, right? So it's about time that small caps participated. This year, we have been more overweight large caps, but we also took a lot of exposure internationally, right? And this has been a global bull market. And it feels like small caps are finally getting to the party.
So one thing you pointed out, we do a weekly call with our amazing Carson partners every Monday morning, and we shared a lot of charts, a lot of stuff. You pointed out, I didn't quite realize this because I was kind of out last week for a couple of days. Last week, you had the S&P up, yet only 2 groups out of the 11 outperformed the S&P's performance: technology, communication services. So there 9 lagged. And then you look, small caps had this great week, large cap tech had this great week, but everything else in the middle didn't do that great, specifically the middle, as in mid caps. Mid caps were down last week, and you've always said mid caps are kind of like the S&P equal weight, and yes, the equal weight has underperformed lately. Take it away on mid caps versus small caps versus large caps, all that, kind of square that circle.
I don't know. That's a puzzle to me. I mean, basically, I literally, I put the charts in there because I was like, I need to ask Ryan about this, because I'm like, and part of it gets to the fact that we're talking about the Russell 2000 doing better than its counterpart, the S&P 600. That's like the Russell 2000, everyone says, and it's true, it's got a bunch of non-earning companies, non-profitable companies, right? It's the junk small cap for the most part. Whereas the S&P 600 is a quality small cap. Well, guess what? Junk has been doing better than quality. But I think there is, and we'll get to the Fed and rates. I think part of it is the tariff uncertainty is lifted. That's helped. And rates going down tends to give more juice to, companies that borrow a lot, maybe not be profitable companies. And mid caps, this is now just solely, I'm always speculating. I shouldn't say this is just speculation. I'm always speculating. So again, take this with appropriate caution. But I think mid caps generally tend to be more profitable than small caps.
Right.
And if profitable companies are not doing as well, at least on the smaller side, well, maybe that's why we haven't seen that participation from everybody else. And which is not to say you're getting, the Mag 7 rallying day after day after day, whether it's NVIDIA, Google, or again, no recommendation to buy these firms, but they're doing really well. They're making tons of profits and cash flows and things like that. But down below, it seems like the non-profitable companies are doing better than the profitable ones.
Yeah, shout out to our buddy Scott Brown. He shares lots of cool charts. Big fan of Scott. He looked at the Russell 2000 relative to the S&P 600, right? So again, which you said, kind of the unprofitable stuff versus profitable stuff on the small side, quality versus non-quality. And he looked at like an RSI, a weekly RSI.
Okay.
It's the most
That's a relative strength
indicator, yes, on a weekly basis. It's the most overbought it's ever been in history. Again, telling you, recently we've seen a huge outperformance of, again, the Russell 2000 relative to the 600.
And that's never happened.
Not to this extent, according to Scott's data going back a couple decades. So anyway, some things are taking place there. Now, I'll tell you, my history of looking at charts and things, usually when you see those initial blasts like that, it tends to say, okay, near term, maybe you're overextended. But that continues, right? So maybe we continue to see kind of the quote-unquote junkier, less profitable areas doing well, which maybe is, again, a play on the potential Fed and some cuts. We're going to get there. But those are some things to think about. And, I do want to go back for us. You know what, Sonu? Remember, Back to the Future? Back to the Future.
Oh, yeah.
We're going to go back to 1929 for a second, because I actually have a couple stats I wanted to share. Get in the cockpit, and one of the things amazing. What Doc Brown? Doc Brown.
Doc Brown. Yeah.
He's like our age right now in that movie. Like,
are you serious?
I don't know.
No.
He's like
47.
No, something like that. Way. Something like that. He looks.
I gotta look it up now.
But he's in his 80s now. But that's a long time ago. So maybe not quite our age. But okay, here we go. This is what I wanted to share here. You're gonna like this.
Are you gonna preface it by saying, Marty?
Yeah, pretty much. So we have 12 all-time highs in the S&P 500 in the month of August and September. I was doing some data on this because, again, it's rare to have that many new all-time highs in those 2 week months. The only month to have, or the only year, the only year to have more new all-time highs in the normally weak-ish months of September and August, take a wild guess, 14 in 1929. So there you go. Again, I'm not going for it. We've had 28 all-time highs this year. Again, 8 so far in the normally weak-ish month of September. Don't get too worked up over that, but it just wanted to bring us back to 1929.
But yeah, to that point about, like, I don't like the phrase. I don't know how you feel about it, but you're a technical guy, so I'm sure you don't care much for that phrase. But yeah. I'm not a fundamentalist guy. It's not like I look at company earnings and say, oh, we should invest in this company or not.
Yeah.
Like, yes, I look at the macro stuff,
right.
But I'm looking for momentum as well in the macro data, right? I'm looking at charts. So I don't like the phrase junk rally.
Yeah.
I don't know how you feel. You probably don't care much for it either, but I just don't like that phrase junk rally. Things that are going up are likely to continue going up, and there are many reasons for that. And people try to say, "Oh no, this is junk. This is a junk rally, so we shouldn't invest."
Mm-hmm. Yeah, I agree. I mean, it's kind of a backhanded compliment, like oversold rally or short covering rally, or my personal favorite, it's a melt up. Like what in the world's a melt up? Like we were hearing that back in 23. Okay, a melt up. What are you talking about? It's a bull market, so in a way, it's a backhanded compliment. Which, if you look at sentiment, I mean, believe me, I can give you anything you want. We saw $58 million poured, or billion, sorry, $58 billion poured into U.S. equity funds last week, according to JP Morgan. That was one of the most we've seen this year, right? We saw a pretty big jump in bulls in some of the sentiment polls. Put to call ratios, like a 5-day put to call ratios, the lowest they've been all year. That doesn't mean we have to peak. We'll be very clear, but there are some signs that, hey, your son's telling you, let's buy gold. I mean, there are some there's some signs that, hey, we've had a heck of a run, and now it's, where are we, right? We're in the Jewish
holiday.
holiday.
He doesn't listen to the podcast, so he's not getting the recommendation from us.
He heard it at recess. Where do you learn most of your lifelong lessons? At recess. And we have the Jewish holiday now, so hopefully people are enjoying the Jewish holiday if you partake. And historically, around the Jewish holiday, markets don't do that well. The second half of September into early October, little weakish. So again, put it with a grain of salt. We understand, but those are some things that are catching my attention from a purely markets point of view. Anything else on small caps, Sonu, before we go into some other things here?
Maybe I do have just a couple of charts to share on that whole bubble thing. I mean, getting it back to, I think we've talked about this before. Look, if we are in a bubble, for one thing, going back to the conversation we had with Cliff Asness, it's hard to say we are in a bubble while we are being in a bubble. It's very hard to pinpoint that. Right?
Yeah. What's the old saying? Please, Lord, just give me one more bubble. Like honestly, it's like, well, we all know it's maybe a bubble, but it doesn't mean it has to pop tomorrow. And we're not in a bubble, and be clear, but still,
one thing,
look at it.
You look for, okay, maybe one sign of it is if valuations are increasing and all the gains we're seeing in stocks is coming from multiple expansion.
Yep.
I don't think multiple expansion, by the way, by itself is a bad thing, because that means sentiment is positive about future profits, right? Now, sentiment can get overextended. I don't think we're anywhere there yet. But we're seeing profits and profit expectations go up too. I mean, Josh, I have that chart, forward earnings expectations still rising. Basically, the line's just going up and to the right, right?
For a long time, about 3 years now.
3 years now. So, like, profit for next 12-month profit expectation for the S&P 500 is about $292 a share, right? I mean, that's just gone straight up. 2025 expectations are $267. 2026 is about $303 right now. That's been going up for months, right? And then if you go ahead.
Yeah, I was just going to say, I've got a chart I use with FactSet data like that. And I think the last time I updated it was May. And I literally updated it like yesterday. And I just plug in the new FactSet data for 25 expected. And both of them are up like $3 or $4. I forget the exact numbers. I'm like, whoa, this is why we're having a 5-month rally, because I'm increasing these numbers that are expected to be earnings for 25 and 26. It's not rocket science when you update it like that.
And there's a way to actually quantify that. So the S&P 500's up 14.4%. This is as of last Friday. We are recording this on the 23rd of September. So 14.4%, you can break that down into, okay, how much came from multiple expansion? Out of the 14.4%, 5 percentage points came from multiple expansion. 8 percentage points came from earnings growth, profit growth, and 1 percentage point from dividends, right?
There
So most of it is coming from profit growth, right? And even profits, where do profits come from? Sales growth and margin expansion. And we are seeing both. So it's a good story all around. Like, even if you take the last 5.5 years, I have a chart over here. Josh, you can share that. It says this is not a bubble. Profit growth has been strong since the end of 2019 through last Friday. The S&P 500 is up 125%. 125%. Now, if this is a bubble, it'd say, you know what? Most of that has come from multiple expansion. But it's not. 30 percentage points, 30 out of 125% has come from multiple expansion. 77% has come from profit growth, EPS growth, forward-looking profit growth, about close to 20 percentage points from dividends. So most of it is quote-unquote fundamentals. For those of you who like the fundamentals, it's not, multiple expansion driving this rally. That's been the case for years now.
So it's fascinating you said from the end of 2019. I was just thinking in my head, just think about that. If all you saw were the headlines, right? I mean, 2020, 100-year pandemic, vicious bear market, 34% bear market in 5 weeks. 2021, I guess we had the SPAC bubble. Everybody's in 2022, terrible war, vicious bear market. 2023, regional bank crisis.
Highest inflation in 40 years.
Yeah, 2024. What do we have? The what was it called? The
yen carry trade crisis.
Carry trade unwind. Everybody freaked out. 2025. We've got worries out the wazoo
tariffs,
still. Tariffs. Liberation Day. I mean, every year. I guess the key thing is every year is going to have some big, scary headline that will cause volatility, that will cause weakness, that will cause some red out there. And it's just so important, I think, to remember that. And you just said, what, up 125%?
Yeah,
125% in the midst of all that terrible stuff we just mentioned. I mean, isn't that
amazing?
Fascinating.
And most of that is profit growth, too. So much for the crash people.
Yeah,
I don't know what you call them.
One of the problems with 1929 or the Roaring 20s, we didn't really have good economic data. We didn't really know what was going on. We just knew it was a bubble. And yes, there were amazing things like, toasters and air conditioners and cars and all types of cool stuff. I always said if I could live, for one period of time from like 1921 to 29, that'd be a pretty cool time to live. Now, I get it. A lot of things I probably complain in about 2 seconds without. So I'm saying this with a grain of salt.
If you didn't know better.
If you didn't know better, it was a wild time. It was a wild time. People having fun, amazing things taking place. At the same time that we all know what happened. But, this kind of maybe leads a little bit to my next thing, Sonu. President Trump has said, why don't we start reporting company earnings only twice a year? Because lots of other places, Josh, I sent the chart. It shows different countries, how often different countries report earnings. Around the globe, the U.S., yes, pretty much all our companies report every 3 months. But then you've got like in the U.K., most of them are semi-annual, right? And then it kind of goes from there. But a lot of European countries don't report all the time. And a big reason for that, because we had the crash of 29. Well, companies didn't even really report earnings back then. It truly was the wild, wild west. And in 1970, there were some more scandals, if you will, in the late 60s. They said, hey, you got to report every 3 months for clarity. And I get it. But the other side, there are some logical, do we really need companies to report this much? President Trump used the quote along the lines of, hey, we're thinking every quarter. China is thinking about companies that'll last 100 years. Carson Group, we're a 100-year firm. Yet at the same time, we do have short-term goals we have to hit. I mean, this is a business. This is a business. We understand. But the reality is you want to hit those short-term goals. You get long-term goals too. What do you think, Sonu? Is there a right or wrong here? I mean, there's some good and some bad to everything. What's your take on U.S. companies maybe reporting only twice a year versus 3 times a year?
One thing is, I would say that if you just look at market returns, the S&P 500 has done much better than
everybody else. Maybe that works.
Yeah, maybe it works. And I think compared to China, I feel like there's a lot of China envy now. I mean, China builds stuff quickly, things like that, but they have a lot of problems, right? And look at the equity markets. I know recently it's been rallying, but if you look at the last 30, 32 years since 94, 95, it's gone nowhere. I think the annualized return for the Chinese equity market, the Shanghai index, is like 1%, 1.5%, but the S&P 500 is above 10%, right? So I don't think there's been a problem by itself. But the other part is volatility, right? Look, and you can compare this to private firms, right? Private firms, how do people come up with estimates for, what a private company is worth. There's something called a fair value estimate, right? Your big private equity shops may say, okay, this company is worth X, that company is worth Y. They're very good at it. That's why they're some of the best in the business. And they come up with fair value estimate. But that is not market value, right? Market value is literally what you and me are looking at every day. What is someone willing to pay for stock A versus stock B versus stock C, right? And I think in the public markets, you have that combination, that push and pull between fair value, what the fundamentalists think, a stock is worth based on cash flows, profits, earnings, things like that, versus, future projections, valuations, technicals, things like that. And there's that continuous push and pull between market values and fair values. Now, suddenly, getting less information from companies, we don't know what fair value is. And when they do tell us what's happened, right, good or bad, usually sometimes tends to be bad, then there's a big move for that correction, right? Market value has to move towards whatever a lot of people think the fair value is. And, things can get wild because of that. So I kind of like this transparency.
No, I hear you.
It's worked out.
Yeah, devil's advocate. Enron was Enron anyway. They were reporting every 3 months, and they were still a big scam. Stuff Bernie Madoff is doing. I know with a publicly traded company, and a lot of it was behind the closed doors. What's the famous Madoff quote? It's a proprietary indicator. I can't discuss it. I think something along those lines. Exactly. I don't have a strong feeling. I mean, I kind of, that's a good idea. Oh, that's a good idea. But it's working. I guess if it ain't working, broke, don't fix it. U.S. markets are doing just fine. I saw some study, I forget who it was. They said something like smaller companies, maybe makes sense for smaller companies to report 4 times a year. Maybe larger companies technically don't. Of course, Berkshire Hathaway. That's a perfect example. I don't think you trust Berkshire. You don't need to hear their earnings all the time. Once a year in May, just go to the big party, in Omaha. But anyway, I don't know. Anything you want to wrap up with this, or just I think it's in the news?
I think we do have, I think again, public versus private. There are private companies, that are not public, basically by definition, that don't have to report at all, right? Nobody knows what they're. So then you're just basically sort of flying in the dark and accepting whatever they tell you fair value is.
Yeah, that's a good point.
Right. So you have to think about public versus private. Which one would you pick, right?
Well, interesting angle there. Yeah. Let's go to the Fed in a second. I'll just say on the YouTube channel, I'm wearing my Reds jersey, or red shirt. The Reds, as the time we're talking, are actually in the playoffs. It's truly amazing. The Cincinnati Bengals won 7 games in a row and then lost 48-10. I don't know if any team in the history of the NFL has ever won 7 games in a row and then lost 48-10. So I think the Bengals are over, but I'm jumping ship to the Reds here. Let's see here. Your Cubbies are good, though. When I'm in Chicago 2 weeks,
fingers crossed, which means my parking situation is going to get worse.
Oh, that's interesting. Yeah, who knows? In 2 weeks, maybe the Cubs and Reds are playing each other in the playoffs. I don't know. I don't know how the playoffs work. I don't know. We'll see. All right, so let's go to the Fed. The Fed finally cut interest rates after 9 months in between. The Fed's fund rate, what is it, 4% on the low end, 4.24 on the upper end?
4 to 4.25.
Yeah, they cut, remember, 3 times last year, 50 basis points in 25. They just cut 25. We've had a lot of time to talk about. I guess I'll just say this. The market did okay on Wednesday, had a huge rally on Thursday. Now, I think Thursday might have been a little bit because the initial jobless claims came back, also relieving people some worry. At the same time, if there a night to sleep on it, market was just fine with what the Fed said. It feels like every day we're making a new high. Talk to me, Sonu. You've had time to think about the Fed. You can talk 90 minutes. I was going to leave right now and find my
You want to go get your cough drop?
I think I'm doing okay.
You know what I'm going to say.
I've heard it once or twice. I'll try to give you a 5 minute. You have 5 minutes, Sonu. What'd you learn from the Fed here in 5 minutes? Yeah, take it away.
I'll give you my top line, and then you know what? You tell me if you disagree. I think what's happening is extremely dovish. A lot of people are looking at why are markets rallying and the labor market is so weak?
Yeah,
I don't think, I'm not in that camp, right? Which is not to say I think the labor market is very strong, but I don't think we are near a recession or the labor market is crashing, anything like that.
Okay.
And the Fed's cutting. Meanwhile, inflation's on the elevated side. I think that is very dovish. I think that's very bullish. It is not a surprise to me at all that markets are rallying. Yeah. Not a surprise at all. Especially small caps and all this stuff, right? So you're probably in the same camp, but you've been listening to me too much. But, So for me, it's not a puzzle, if that makes sense, right?
No, I think you're right. I mean, I think the market sniffed out these cuts a while ago.
Yeah.
It's leading
Yeah.
home builders, small caps, like we already talked about.
Yeah.
I mean, it kind of sniffed some things out. Powell called it a quote unquote risk management cut, or as you said, or insurance. You on our call yesterday with our partners, you said, listen, another word for that is insurance cuts. Well, I mean, let's talk about what people actually probably care about. When they cut interest rates last year, short-term rates went lower, sure. Long-term rates pretty much went straight up. Not too many people expected that. What do you think's going to happen this time? Let's say they cut a couple more times this year. That's what's expected. What are long-term rates going to do? We're going to see another surprising move up because for what it's worth, mortgage rates have been going lower. We saw a huge jump in the number of people applying for mortgages and refis and things like that in the last 2 weeks, which is great. It'll unlock the economy. I know you got some thoughts on the consumer here in a minute or two. What are you feeling here if they cut a couple more times?
Actually, right now, I'm not so sure because I think these cuts are here to stay. Last year, remember, we were talking about going into September of last year. Remember, we were talking about like a 50 basis point cut being priced in, things like that. And we'll talk about the possibility of that, with respect to this meeting, which I thought was very interesting with respect to dynamics within the Fed itself. But last year, we got 50 basis points. But what was happening before that? The SAM rule, remember the SAM rule? The SAM rule was broken. The unemployment rate had gone up. I mean, there was concerns about the labor market. I think it was more normalization than big concerns. But rates are also very high. Rates are 5.5. It wasn't at 4.5, right? So there was that piece of it too. And so, between July and September of last year, the 10-year yield went down a lot, right? Because markets are worried about, is growth going to slow down? We got a few recession calls. We got the yen carry trade crisis in August. All of that laid the groundwork for yields to pull back really, by a lot, the 10-year yield. And then what did we see after the, 50 basis point cut? They cut again by another 50 basis points in November and December, 25 basis points each. So they cut by a total of 1 percentage points, right? That's what got the rate down from 5.5 to 4.5%. And we saw the 10-year yield going up. But that, I think markets are just saying, it was like a relief, right? Okay, we still see strong growth. And that's what we saw. We saw close to 3% GDP growth last year, right? So the 10-year yield, that's what it told us. That's what the rally told us, right? This year, I think it's slightly different. I think the 10-year is going down. I don't know that it is going back to, let's say, 4.5%. Yes, inflation's high. But what the Fed and what markets are pricing in is that not only is the Fed going to cut over the next 2 months, they're going to cut a lot next year. Yeah. Right? So even the future. Are
these one of the charts you have? Do you have a chart that says this? Or?
Yes. So I have markets are much more dovish than the Fed near-term charts. That's a chart. Okay. But much more hawkish long-term. Right? So let's talk about Powell mentioning this is a risk management cut or an insurance cut, right? So they have two mandates. Stable inflation and maximum employment. They're neither are in good shape. Neither side of that mandate. The labor market risk is high. We know that from payroll growth data. That's been weak. All of that. We got negative jobs in June. But inflation's also near 3%. That's well above 2%. I don't think anybody, if you ask them right now, do you think inflation's coming down to 2% in the next year or two? I don't think anyone's going to say yes.
Probably not.
Right? Nobody. So inflation's the problem as well. So which side do they focus on? And the Fed gave us their answer. They're going to focus on the labor market. They're worried about a downward spiral in the labor market, an upward spiral in an unemployment rate, rather than a really scary inflation spiral, right? They think actually inflation risk has eased since the summer. The tariff impact will be transitory. Powell didn't say that, by the way. But our friend Kashkari was on CNBC on Friday morning. I think you were on CNBC too. So it must be sometime before. So he was there on Friday morning, and they asked him about inflation. He said, the tariff impact should be one-off, but it may last 1 to 2 years. I'm laughing to myself.
Yeah. Okay, and Kashkari, he loves the camera. He loves the camera. Yeah.
So anyway, the dot plot, right? So the June, September, December, and March meetings when they update the dot plot and summary of economic projections. They say, these are our estimates for GDP growth, inflation, unemployment rate, and based on that, this is where we think policy rates will be. What was interesting for 2025, they revised GDP growth up, Ryan, from 1.6 to 1.8%. So that's good. Inflation, they left it unchanged. Their estimate for 2025 core inflation is at 3.1%. No change for June. No change from June with respect to the unemployment rate. They kept it at 4.5%. We're at 4.3% right now. And they signaled 3 cuts in 2025. Right. Inflation's above. Unemployment rate is not scarily high. GDP growth has been revised up. I mean, you tell me if they're projecting 3 cuts, is that bullish or, bearish? Is that dovish? Or I think it's very dovish.
Yeah. And I love how you look at we're guessing, right? Who's I don't know. I keep hearing typing. Is that you're not typing, are you, Sonu?
No, I'm not.
I swear, Josh, I swear we hear you typing. I don't know what's going on. I'm hearing somebody type. I know it's not Sonu. I'm not sure what's going on. I'm losing my mind here. Somebody's typing. Anyway, there are 19 voting members. One of them is looking for a hike the rest of this year. And then there's one particular, we're going to assume gentleman, because he literally came out and said it was him, who's looking for 2% of, well, how do I put it? 200 basis points of cuts, right?
2 percentage points of cuts. He thinks the rate at the end of the year should be 2.9%. For prospective people right now, we are at 4.1%. He thinks it should be 2.9%.
Is that dovish?
So let's actually talk about the person who thinks there should be a hike. I think what happened there was there are 19 members in the FOMC. Mm-hmm. There are 19 members on the Federal Reserve, and only 12 of them get to vote, right? Okay. 7 members are the Fed regional presidents, right? Your, Kansas City Fed, Chicago Fed, etc. Minnesota, like Kashkari's from Minnesota, right? Yeah. Cleveland, things like that. So only, there are 12 of them. Only 5 of them get to vote every meeting. All the Fed governors vote. So Powell's a governor, Michelle Bauman's a governor, Chris Waller's a governor, Stephen Moran, who just got onto the committee on Tuesday morning. He's on, I don't know, maybe a loan from the White House. It's
like it feels like a kamikaze mission almost. It comes in and just, I don't know.
Blew up the estimate. But anyway, so I think what may have happened was, I think it's a Kansas City Fed president, Jeff Schmidt. Right. Jeff Schmidt, who basically, his dot shows a hike for this year.
He sounds like a car dealership. Jeff Schmidt. I swear there's a Jeff Schmidt car dealership in Ohio. I looked at it. I swear there's a Jeff Schmidt Honda.
Maybe it's his.
Exactly. I don't know. Could be anyway.
Yeah. Right. So what happens is just, how these things work. Before the meeting, they're asked to give them, asked to turn in their, summary of economic projections and dots and things like that. So he probably...
Yeah, Jeff Schmidt Chevrolet. There it is. Yeah, Jeff Schmidt Chevrolet. I knew I heard that. I literally think I bought a car from the guy like 15, 20 years ago for my wife.
Jeff, from the Kansas City
up in Miamisburg, Ohio. Jeff Schmidt. I think it smelled differently, but nonetheless, there you go. Yeah.
So I think what happened is he basically is in the camp that the Fed shouldn't do anything this year. Right? Mm-hmm. They shouldn't cut rates. And that's why his dot is where it was at 4.4%. But then the Fed lowered rates to 4.1. So it looks like he was calling for a hike, whereas I think he was just calling for no action whatsoever. Right. But I think the dot that matters is actually Stephen Moran's dot, because what happens? So the Fed's projecting in the dot plot 1 more cut in 2026. They're projecting 3 this year, including September. Right. And 1 more next year.
I'm going to say only 1 next year.
Only 1.
Off. Yeah,
only 1 next year. Mm-hmm. And now this is all based on the median, right? Mm-hmm. The median dot. But if you look at the actual distribution, there are 19 members, as I said. All of them have different opinions. 7 out of the 19 don't think there should be any more cuts this year. Right. And 2 think there should be 1 more cut. 9 out of 19 think there should be 2 more cuts, and that's why the median is at 2 more cuts. Okay. But what's interesting is Stephen Moran's dot, right? Moran's a former chair of the Council of Economic Advisors. He's a new member. He just got appointed on Tuesday last week. That's the morning of the meeting. It must be interesting, the dynamic. He just walks in there, new guy, he takes his sheet, takes, whatever he's supposed to fill out the form and just blows everything up.
Eats all the bagels. He eats all the bagels. He drinks all the coffee, and then he throws out the cut interest rates 200 basis points. And then he leaves. He drops his mic and leaves.
So... No, the big picture is, look, the members are all over the place, especially for 2026, right? The rate estimates for 2026 range from as low as 2.6%. Remember, we are 4.1 right now to 3.9%, right? So some members are projecting 6 more cuts. Some members are projecting only 1 more cut. And that's why I think Powell didn't commit to more easing. And I think part of it is they probably want to avoid unnecessary panic. I do think they're very worried about the labor market, but what's a good way to act on that? Cut 50 basis points, right? But if they do that, suddenly everyone's like, wait, are things worse than we actually think it is? Right? There is that dynamic. And there is also, I think, look, Waller and Bauman called for a 25 basis point cut in July. They dissented. Remember that?
Yeah.
So I would have expected them to say, you know what, we want 50 basis points this time.
Yeah,
I
agree. Yeah.
They didn't dissent, right? Only Miran dissented. So I wonder, part of the, dynamic in the Fed is that, you know what, we want consensus as much as we can get it. Yes, there's this one guy who's coming from the White House. He's going back to the White House probably in January. So set him aside. The rest of us are going to get consensus. Let's just do 25 basis points. Even Powell said 50, interestingly enough, a 50 basis point cut was not even under serious discussion. It was almost Powell's way of pushing back against the president, saying, you know what, we're independent. I don't think any of it matters, Ryan, because next year, Powell's going to be replaced by President Trump.
And that's, I think, the key concept, because if you look at Fed funds futures, they have more than one cut next year. What's that looking for? 2 cuts or so?
They're looking for 3 cuts.
That's what I thought. I thought it was 3. So again, we
3 this year, 3 next year. So 6 cuts total.
We talk about this stuff a lot. The reality is the Fed is more dovish. There's more coming, probably. What does it all mean? Well, the market seems to be taking it in stride. I mean, I might sound like a broken record, but it's now 21 out of 21 times where the Fed cut within 2% of an all-time high, like they just did last week. That's, again, the closing basis, the day before the decision. Market's up a year later, 21 out of 21 times, like 13, 14% average. I think it was 18% this time. Remember, a year ago, I think it was the 17th, last year in 2024, the Fed cut 50 basis points. Everybody out there, except for this very podcast, were saying, oh my goodness, when they cut 50, like early 2021, October 2007, what's the other one? 100-year pandemic. When they cut big with the first cut, they know something bad is coming. We said, no. They should have just cut 6 weeks before. They didn't. They're just playing catch up. Fortunately, that's been the case. Yeah. I'm kind of glad they didn't do 50 because, that's kind of like, maybe we don't know what we're doing here. We should have been cutting, because we were saying the whole time back in January, February, they probably should have cut a couple times. They didn't. Who knows where we'd be. But the reality is, listen, S&P is up 14% the time we're doing this for the year. So we're not one to complain. So
and right now, inflation's elevated, and this will seg into, I know we're going to talk about retail sales and touch on that.
Yeah, let's go to that. Let's finish up with that.
I just don't think the labor market is as weak as the data is telling us. I do think it's not great, but at the same time, I don't think we're on the verge of a recession. We're going to see multiple months with negative job creation, things like that. Look at initial claims data. That normalized after one brief spike because of fraudulent claims in Texas. So I think this talk about like labor market weakness may be a little overdone. Like I said, I want to caution that I don't think it's fantastic, but I don't think it's falling off a cliff. And I think what happened in summer is just extreme tariff uncertainty. We are beyond that right now. Claims are not showing that layoffs are climbing, anything like that. And even within the JOLTS data, the job opening labor turnover survey, hiring stabilized, quits aren't collapsing. Look, if the labor market is in bad shape, right, people wouldn't be quitting their jobs at the rate they are right now.
Right. I mean, layoffs, we see some, right? But they're by no means soaring either. No. Speaking of initial jobless claims, it was 263. Then they revised it up to 264. So anyway, if there was fraudulent, they found more fraud, apparently. But the reality is it came down to 231, expected to be 241. So the reality is, again, that's a nice real-time example of what's going on, and you can use that. And again, I think that's a big reason why on Thursday, after the Fed, we had a really nice rally. Because, wasn't so scary. We're kind of near the end, Sonu. Let's talk about retail sales. I know you want to wrap some things up with retail sales coming in better than expected. The last 3 months, I think it's 0.6%, 0.6%, and 1% annualized is over 9%. The control groups ballpark 8% annualized the last 3 months. That doesn't sound like a recession. It doesn't sound like a consumer that's tapped out just quite yet. Yes, some of that clearly is higher prices. We are aware, but the reality is the consumer keeps coming in better than expected. Take it away on retail sales and the consumer.
Yeah, no, as you said, the last 3 months, retail sales has been 9% annualized. One data point that is interesting that comes out of that is restaurant and bar sales. Technically, it's not good spending, that's services, right? But it tells you that's very discretionary spending. Last 3 months, it's up 6% annualized pace, right? Yes, some of that is inflation. CPI for food away from home is 4%. So you take that out of the 6, and now we're left at 2% inflation adjusted or real growth. That's not too weak. That's not too strong either, but it's not really weak. So that is part of my reasons of like, you're always looking for puzzle pieces. You can't just follow one data point. You put everything together. And I'm looking at the totality of data right now. And I'm like, oh, maybe the labor market isn't as weak as everyone thinks it is. That's just me. Look at the Q3 GDP nowcast from the Atlanta Fed. That's running at 3.3%. Now, a big chunk of that is inventories, but you take core GDP, right? Real final sales, households, business investment, government. That's running about 2.5%, 2.6%. That's pretty solid. It's on trend. Yeah. Now, I know 23, 24, last 2 years was much higher. It was about 3.2% core GDP. But 2.6% is not bad, right? And you could say, okay, that's a lagging indicator. But remember, we haven't gotten Q3 GDP data. This is based on all the data that's coming in as of July and August and into September too. So, yeah, I just don't think we are in that bad of a shape as, we lost jobs in June. I have a feeling that's going to be revised up, but that's purely speculation. I have no idea. At some point, we'll look back at the summer of 2025 and think, yes, there was a lot of tariff uncertainty, but that was just temporary. It passed, and things are looking okay.
No, I think. I like to always have an optimistic view on the world. I think that makes a lot of sense. So again, next week, we're going to talk about next week's podcast. We already recorded it live from Excel on stage with no one there. It's kind of weird to do these with nobody there, but we're going to share it. Mr. Jan van Eck. I'm not sure his title. Probably founder.
Probably, CEO, CIO.
Sorry, compliance. We don't know his title. But Jan van Eck over at Van Eck joined us. High level, what would we talk about, Sonu, without giving too much away?
I mean, mostly diversifying portfolios. We talked about gold, obviously, because they were the first firm to release the gold miners.
His dad. The stories about his dad's awesome. You're gonna love it hearing about his father, his career.
I may actually make my son listen to that.
So
we'll see how it goes. And because he was like, it's only, you could invest in firms potentially because this is not a recommendation that dig into rocks looking for gold. And the idea was very appealing. It's like, oh, you can do that. I was like, yes. Now I'll listen to Jan van Eck, right? So and then diversify. You talked about crypto as well. I thought the discussion about crypto was very interesting. So definitely tune in for that.
Absolutely. That was a neat one. That'll be next week. But this was again episode 154 of Facts versus Feelings. No, this isn't 1929, which I think is hopefully a good thing for a lot of us.
Leave a comment, right? Leave a comment.
Well, that's what I was going to say. Yeah, leave a comment, leave a review. The YouTube channel now has comments. Do us a favor. Go on there and say something. We don't really care what you say. It's just the algorithms love comments. Maybe say something nice, but definitely do that. And I will say also some really cool news. I'm going to pull this up here. We'll kind of finish up with this. Barron's just released their top 100 RIA firms. It's the 10th annual ranking of independent advisory companies. It's based on assets managed by firms, growth, technology spending, succession planning, and other metrics. So, hey, it's proprietary. Remember my joke about proprietary? It's theirs. But
is Barron's public or private? I don't know.
I don't know. I'm a fan. I love
Barron. It's part of the Wall Street Journal, right?
So it's under that. Yeah, I mean, I know this much.
I
pay some money every month to read Barron's, read Wall Street Journal, and Market Watch. Are all under that same kind of umbrella. Big fan of all of them. But anyway, Carson Group was number 6 in 2024. We move up to number 5 in the most recent top 100 RIA firms out there. So thanks again to Barron's for that cool honor. But also I think thanks to hopefully all the amazing partners that we have and employees that we have that keep working, trying to change this industry for the better and try to help our partners grow and try to help their clients at the end of the day. If you're interested in learning a little bit more about it, it's carsongroup.com. I'm sure we'd love to talk if you're a financial advisor that's looking to, love your business again. It's something that Bert White, our CEO, has said before. I think that makes a lot of sense. I've worked with financial advisors the last 10 years now, and, there's pros and cons, ups and downs. But again, I think if you see what's going on over here at Carson, we can really help you love your business again, grow a little bit, and help your clients. So anything else you're watching this week, as again, the first week of fall is upon us?
We, at the end of the week, well, I'm going to Connecticut and New York. So, I'm hoping for some good weather there.
There you go. Yeah.
Right. And, but no, I think in terms of data, macro data, I know PCE inflation data is coming, but we kind of know what that's going to be. So that's not going to be a big surprise. Personal income and consumption. I'm kind of curious where that lands and what that does to the Atlanta Fed's Q3 GDP nowcast.
Okay.
Because that's going to be at the end of the week. That'll be Friday. So that's basically what I'm looking at. Otherwise, I'm just looking for a quiet week. And next week, we are all traveling to Omaha for our Carson Days retreat. It's an employee stay. We call them stakeholders at Carson, not employees. So it's a stakeholder retreat. Everyone gets together. We haven't done this in a few years, so that'll be fun.
Yeah, last October, our team all flew to Omaha, the investment research team, but this is a big chunk of the company is all coming in for the day next week, which will be really cool to see everybody and see, again, our research team to hang out face to face, which is always a lot of fun. So yeah, I guess for me, markets are calm. I'm on CBC in a couple hours. Once I get through that, just kind of good, whatever. My son's got a football game later, but I'm all of a sudden a baseball fan because the Reds have gotten hot. The Reds are in it. I've told my boys 3 weeks ago, the Reds are going to get hot. They're literally going to lose the last day, which is Sunday, and just break our hearts because that's the Cincinnati way. So anyway, so I'm looking forward to watching some baseball games that actually matter potentially in the month of late September, which hasn't happened in about 10 years here in the great city of Cincinnati.
And hopefully into October, right?
Well, I'm not going to jinx it. Yeah, at least that's why I said God gave us Ohio State. They're always good at football. So every other team's just so frustrating. All right, listen, everyone. Thank you for listening. Thanks for all of your comments and likes and what else? Downloads and listens and all that stuff. It helps us grow this really fun podcast that we keep doing. With all that, everyone, again, this was episode 154. No, this isn't 1929. See everybody, I guess, technically in 2 weeks with another live one, but you're going to love next week's podcast again with Jan Van Eck over at Van Eck. He brought up some really cool stuff. It was really fun discussion. See everybody see everyone in 2 weeks. See you. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.